This is how silver stories usually start. Not with one giant headline, not with one dramatic exchange failure, not with a clean, satisfying moment where the whole world suddenly agrees the market is tight. They start with a handful of separate events that look unrelated right up until they begin leaning on the same pressure point. China restricts exports. Trump targets Mexico with tariffs. COMEX registered silver sits at roughly 13% of where it stood at the 2020 peak. And then, silver notices. That last part matters, because silver is one of those markets that can look asleep right before it starts acting like a market that knows something. And when it does, people tend to make the same mistake every time. They assume the move itself is the story. It usually isn't. The move is the reaction. The story is the structure underneath it. Let's clean this up, because if you say this sloppily, it turns into internet nonsense fast. China did not cut silver exports in the simple, literal sense. What Reuters reported is that the US has been scrambling to secure critical mineral supply chains after China rattled markets by withholding key materials. That matters for silver, not because silver was the exact export control target, but because it reminds the market of something it keeps trying to forget. Strategic metals do not trade in a vacuum. Once governments start weaponizing resource flows, the premium on supply security rises everywhere. Then there is Mexico. Again, precision matters. Trump did not wake up one morning and declare a silver war. But Reuters has documented tariff threats, tariff suspensions, metal tariffs, and a pattern of trade pressure involving Mexico, including 25% tariffs on many imports at one stage and later escalations in metals-related trade actions. Mexico matters enormously in any silver conversation because it is one of the world's most important silver-producing countries. So even when the policy target is broader than silver itself, the market still has to ask the obvious question. What happens when one of your most important producing jurisdictions is suddenly sitting closer to geopolitical friction? And then you get to COMEX. This is where the story stops being abstract. Because people love talking about plenty of metal in the system, but delivery stress does not care how much silver exists in a philosophical sense. It cares how much silver is actually registered, warranted, and available for delivery against futures contracts. And market commentary tied to CME data has been flagging that registered silver has collapsed from around 240 million ounces in 2020 to a level near 13% of that peak in recent periods. That does not prove imminent failure. It does prove the cushion is much thinner than it used to be. That is the thesis. Not silver is gone. Not COMEX is defaulting tomorrow. Not every tariff headline means $200 silver. The real thesis is much more disciplined than that. The silver market is being forced to reprice supply security in a world where strategic export restrictions are rising. Major producing countries sit closer to trade conflict, and the main futures delivery system has a far smaller registered cushion than it had when this cycle began. That is a serious sentence. And it should bother you if you still think silver is just another sleepy precious metal chart. Because silver is not priced by one world, it is priced by two worlds at once. The first world is the physical world. That world cares about mine supply, refining, trade flows, industrial demand, fabrication, bars, coins, solar, electronics, and inventories. The second world is the financial world. That world cares about futures positioning, liquidity, tariffs, geopolitics, margins, panic buying, and liquidation. Most of the time, people analyze one world and forget the other. That is why they keep getting blindsided. Imagine an electrical grid that has been running close to capacity for years. Now imagine one supplier becomes politically unreliable, another major line comes under tariff pressure, and the reserve margin inside the grid shrinks at the same time. Does the power fail instantly? Not necessarily, but the system becomes more fragile. That is silver right now. China-related export restrictions raise the market's awareness that critical supply chains can be weaponized. Mexico-related tariff pressure raises concern around a crucial producing corridor. COMEX's much smaller registered stockpile means the paper side of the market is operating with less room for error if physical demand surges into the wrong moment. This is exactly where bad silver commentary splits into two useless camps. Camp 1 says, these are separate headlines. Nothing to see here. Camp 2 says, this guarantees a silver explosion immediately. Both are lazy. The better interpretation is that each event increases the market sensitivity. And when enough sensitivity piles up, silver starts reacting harder to smaller triggers. That is how fragile markets behave. There is another layer here that matters. When governments start talking tariffs, controls, exemptions, strategic minerals, and industrial self-sufficiency, they are not just changing trade flows, they are changing behavior. Fabricators start thinking about security of supply. Investors start thinking about bottlenecks. Traders start thinking about which metal is still underappreciating the policy risk. That behavioral change can matter before any measurable shortage becomes visible on a retail chart. That is why the phrase "silver noticed" is actually useful. Because silver rarely moves when the public thinks it should. It moves when the market structure suddenly realizes it has less flexibility than it assumed. And what are the signs of reduced flexibility? Smaller registered inventories, repeated policy shocks around trade, pressure on key producing jurisdictions, a broader geopolitical shift toward resource nationalism. Those are not memes. Those are structural inputs. Now, let's stay honest. None of this means every silver rally will stick. None of this means tariffs automatically reduce Mexican silver flows tomorrow. None of this means China's critical mineral restrictions mechanically convert into an immediate silver shortage. And none of this means COMEX cannot continue functioning with thinner registered inventories than many people are comfortable with. Those are all fair cautions, but caution cuts both ways. Because not immediate is not the same thing as not important. That is the trap people fall into constantly. They hear that the system can still function and assume the pressure is imaginary. It isn't imaginary. The market does not need an official breakdown to start repricing fragility. It only needs enough serious participants to realize that the world has become less forgiving while the inventory cushion has become thinner. And that is exactly why silver can wake up violently after looking quiet. You do not need every silver ounce in Mexico to be threatened. You do not need China to ban silver. You do not need COMEX to run out. You just need a market that realizes it has been relying on assumptions that are no longer as safe as they looked 6 months ago. That is enough. That is often more than enough. So what should a serious viewer take from this? First, supply chain politics now matter more for silver than many investors still admit. China's willingness to weaponize critical material exports changes the mental model for metals broadly, even when silver is not the exact first-line target. Second, Mexico is not just another country in the tariff story. It is a major silver-producing jurisdiction, which means trade friction around Mexico automatically raises the strategic temperature around silver. Third, COMEX registered inventory being down to roughly 13% of its 2020 peak does not prove collapse, but it absolutely does mean the delivery cushion is much smaller. In thin systems, small shocks matter more. And fourth, this is why silver noticed. Not because one headline magically changed everything, because multiple pressure points started leaning on the same part of the structure at the same time. That is when silver stops acting boring. The mistake people will make now is asking whether this proves the silver bull case in one shot. That is too simplistic. The better question is whether the market is becoming harder to stabilize, whether the cost of a future demand surge is rising, whether the margin for error is thinner, whether the next shock has a better chance of causing disorder than the last one. Those are silver questions now, and they matter more than slogan-level debates about whether a shortage is real. Because the most dangerous commodity markets are not the ones where everyone sees the problem clearly. They are the ones where the system still works just well enough for most people to dismiss the ENBT clues until price stops dismissing them. That is the real thesis here. China restricted exports. Trump targeted Mexico. COMEX sits with a much smaller registered silver cushion than it had at the 2020 peak. And silver noticed. Not because the market is irrational. Because the structure is tighter, the world is noisier, and metals do not wait for the public to feel comfortable before they reprice risk. If you want, I can do the thumbnail prompt next in the Grant Walker style.